Let's talk about Chapter 7. I'm looking in the book on page 271, and you can see that Chapter 7 is about inventory and cost of goods sold. And let's talk about inventory. And you can see here that there are a few different types of inventory to be thinking of. And inventory itself, just think of as anything that a company is acquiring so that it can then later resell it. Okay, now we're talking about inventory from the perspective of not just a merchandiser, but also from the perspective of a manufacturing company. And there's a good timeline they show us on the bottom of page 271, and you can see it there with some pictures in terms of the activities of buying, adding value, selling inventory for a manufacturing company, and also the journal entries that go along with that. So just be aware of that. That's just a good review. But let's keep in mind then when it comes to inventory that we have raw materials, which is the materials that we buy to use in the manufacturing process. And on page 271 they're showing a company buying wood and some other inputs, adding some value like labor, manufacturing, some other materials like paint and varnish and whatnot to build a table and chairs, dining room table and chairs, which are then sold as a finished good. Okay, so raw material would be the materials needed to make the table and chairs, things like the wood, glue, nails, stain, varnish, whatever you need to make a table and chairs. Okay, then you have work in process. Work in process are goods that are partially completed. So we stop and we measure every so often. When we get to the end of an accounting period, we stop and we measure. And we stop and we compute how much furniture have we started, but we've not yet finished making it. That's called a work in process or a partially completed unit. Then we have finished goods. Those are tables and chairs that are completely through the manufacturing process, are finished and ready to be sold to our end buyer. If that's another furniture store or a customer, whoever that is that will buy that from us, then we've got finished good ready to sell to a customer. Cost of goods sold then represents all the costs that were incurred to manufacture a product. Okay, so if you think about a dining room table and chairs, you're thinking obviously the cost of buying the raw materials. You're also talking about the cost of adding value in terms of that value being labor that was added, and then the overhead associated with that labor and the manufacturing process. Okay, all those costs are captured and then turn into the finished good inventory number, and then when we sell that finished good, it becomes a cost of goods sold. Okay, so costs included in inventory include the raw materials, the labor, the overhead, which they say here are indirect manufacturing costs that are associated with producing inventory. Okay, so if you just think of a production floor of a factory, just think of a wood shop or a wood factory where tables and chairs are being made. Okay, we can easily tell who's working on these, right? The direct labor, there's no challenge with that number. We know exactly who is working on an item and adding value to turning raw materials into a finished good. Okay. Next is the indirect labor though. Okay. Indirect labor would be a supervisor. Obviously, if we've got laborers running manufacturing equipment to make something, we then have supervisors above them making sure that they're trained properly, scheduling people, some things like that. But they're never actually working on an actual finished good. You might also have some maintenance people. You've got some people in the shop who regular maintain machinery, who fix machinery if it breaks down. You might have a custodian who cleans up the shop every night, make sure the floors are swept and clean and free of debris so we still maintain a safe working environment. None of those people are actually working on the desk and chairs, so they are indirect labor, but still a cost of making the desk and chairs. Okay, And so you've got overhead like that. You've got overhead in terms of the manufacturing equipment, the factory itself, the building that you're in, the utilities, depreciation, anything associated with building that product is overhead. Okay. You also have freight in, paying the freight to receive your materials, just any cost that goes into the manufacturing and production of the finished good should be included in that ending inventory number. Okay, so just keep that in mind. That's from the manufacturing perspective, which is what they throw at us right away in the chapter. Okay, next is who owns inventory. Okay, who owns inventory? When goods are in transit, who owns it? Okay, when inventory is on a truck or railroad car, who owns it? The answer is whoever's paying for the freight. It could be that the buyer is paying the freight, then the buyer owns it when it's being shipped. If the seller is paying the freight, then the seller owns it when it's being shipped. Okay, so it's a pretty simple answer there. How about a consigned good? Who owns goods on consignment? Some secondhand stores. I know there's a few in Sioux Falls. Kids secondhand stores. If you want to sell an item, you can consign the item. You can take an item to one of these stores and they will sell it for you. They keep a percent of the sale or they charge a fee and you get the rest. There's a place in town that will sell your vehicle for you. They'll take it on consignment. You can put it on the lot and they will do everything in their power to sell the vehicle for you, and they're just going to charge you a fee for doing that, a fee for keeping it on the lot, and then a fee for the transaction and to process the sale. So when it's under consignment, right, that auto dealer, that secondhand store, if it's taking a good on consignment from a customer, they don't own it. Okay, they're selling items that they don't own. They're helping somebody sell the item instead, and so they're getting a fee or a commission based on that inventory selling. Okay, but they don't technically own the goods, so it's a little bit different. When it comes to inventory, we've got two ways to look at it: perpetual versus periodic. Perpetual means that we're maintaining a detailed record of the number of units on hand and the cost of each unit, and also the sales price throughout the accounting period. So at any given moment in time, we know exactly what inventory we have on hand in terms of the cost and of the dollar amount or the units and the cost of inventory on hand. There's no question about what we have on hand. Okay. On the flip side, then you have the periodic method. The periodic method says system of accounting where cost of goods sold is determined and ending inventory is adjusted at the end of the accounting period, not when merchandise is purchased or sold. So in other words, the only way we know what we have on hand is to do a physical count, which we typically do at the end of an accounting period. Okay, so perpetual versus periodic. Now, perpetual is much more common, and the reason it's much more common is we're talking about barcoding and scanning, and this is very commonplace now with technology that's been around for a long time. It's not super expensive, so typically most companies are using the perpetual method. Plus, it's more efficient. It's always good to know what we have on hand so that we can place orders with our suppliers, have inventory on the shelves in time that we're not running out. Okay, so perpetual has a lot of advantages. So some of the journal entries that we'll make will be different based on which method we're choosing, perpetual versus periodic. And now they start to talk about each of these in your book on pages 274 and also on 275, so just be aware of that. And they start to discuss a difference in the journal entries also on the bottom of 275 and also on 276. And you can see the differences here. Perpetual, whenever I buy inventory, I debit the inventory account. If I buy an account, I credit accounts payable. When there is transportation cost, if I'm, as the merchant, paying for the freight, then I need to debit inventory for a freight charge and credit cash. Whenever there's a return, then of course I'm debiting either accounts payable or cash and crediting inventory. And then if I take advantage of a discount, I use the inventory account. Okay. Different than periodic. Periodic is, you can see the differences in accounts. In the periodic method, I'm using an account called purchases. I'm using an account called freight in, purchase returns, purchase discounts. So the key word is the word purchases with the periodic method. On the perpetual method, I'm focused on the inventory, because with perpetual, I always know how much inventory I have on hand. Therefore, I have to debit or credit the inventory account. With periodic, I'm keeping track of how much inventory I've purchased, and then I have to do a physical count to know what I have on hand. Some other entries when it comes to selling your inventory, you can see with the perpetual inventory is sold, we debit account receivable, credit sales, or we could debit cash, credit sales. And then we have to debit cost of goods sold and credit inventory to make sure that we remove that inventory from our accounting to continuously be updating the inventory balance. With periodic, I only record a sale. I debit receivable, credit sales. I'm not doing anything with the inventory account until the end of the accounting period when I do a physical count and I count how much I have on hand and I do a closing entry. I don't do closing entries with perpetual. I only do them for periodic inventory. Okay. So perpetual is definitely the one that's used the most. Just keep that in mind. Okay. Inventory counts. Now keep in mind that we still have to do inventory counts with perpetual. At least once per year we still have to do a physical count. And we do that to determine the amount of inventory shrinkage. Okay. Shrinkage is how much inventory has snuck out the door without being accounted for. Okay. So we're talking primarily shoplifting, even employee theft, errors, and then just inventory that was damaged but never written off. Okay, so shrinkage, or that physical count, will help us keep track of the amount of shrinkage that we have. And the physical count, then what we do is we count inventory, the number of units we should have on hand. We compare that to our perpetual records. They're always going to be different. They'll never be the same. Typically, the physical count is lower than the perpetual accounting records, because inventory sneaks out the door. Okay, it's just a matter of business. It's going to happen. There will be shoplifting. There will be employee theft. There will be inventories damaged. We will make mistakes. Which leads us to the cost of goods sold calculation. The cost of goods sold calculation is not too bad. The perpetual method here you can see on the left side. With perpetual, we take our beginning inventory, we add purchases, that equals cost of goods available for sale. So beginning inventory plus inventory that we purchased represents the amount of goods that we have available to sell to our customers. At the end of the accounting period, we then count what do we still have left, what's left over, what do we still own. The difference between what's available to sell versus what we have on hand then becomes cost of goods sold. And that cost of goods sold number then, of course, is an expense account on the income statement. With periodic, we're going to get to the same answer for both methods, just how we get there will be different. With periodic, we're taking our ending inventory, okay, and we are then subtracting our count. And what's different? We're getting a shrinkage number, and then we're taking our cost of goods sold number, adding to that to get the total cost of goods sold. Okay, we have some assumptions when it comes to the flow of inventory as inventory flows through our store or through our business. Okay, you can see here we've got some acronyms, FIFO and LIFO. FIFO stands for first in, first out. LIFO stands for last in, first out. We've got the average cost method, and we have the specific identification method. Okay, and these are all assumptions. FIFO says the assumption is that the oldest units are sold first. LIFO is the assumption is the newest units are sold first. So they're direct opposites of each other. Average is purely just tracking what's the average cost of each unit. To compute average, we keep track of how many units we purchased or how many units we have, and we also calculate the cost of those units, and we average the two to get an average cost per unit. Okay. Next is specific identification. Each item on hand is specifically identified. Typically, it's used for larger and expensive items that are uniquely identifiable. They say cars is a great example. Every vehicle that would be on a dealer's lot would have a unique vehicle identification number, so it's separately identifiable. Okay, that's a key thing when it comes to specific identification. Can I separately identify each piece of inventory in the lot? It's hard to do. Not many businesses can do that. So the inventory has to be unique. Real estate, where each property is unique. Vehicles, expensive designer jewelry, where each piece might be separately unique and identifiable. So it's not used as often. So what are more common are the top three: FIFO, LIFO, and average, with FIFO and LIFO by far being the most popular methods. So here's an example of inventory cost flow, and we've got a company here called Rice King. They're buying and selling rice and have the following transactions throughout the year. On June 10th, they purchased 10 tons at $6 a ton. On July 28th, they bought some more tons, 10 more tons at $9 a ton. Then on October 10th, they sold 10 tons at $11 per ton. So the question then is, how much did they make during the year? And the answer is, it depends. It depends on which method did they use. Okay. So they're selling their rice at $11 per ton. So their sales price here then is always the same, no matter which method, FIFO, LIFO, or average. It's always 110, 10 times 11. Okay, so the sales price is the same. But what's different then is the cost of goods sold. Okay, for FIFO, first in, first out, we're assuming, or the assumption is that the oldest tons of rice are sold first. Okay, which is the 10 at 6. So we're saying cost of goods sold should be 60, gross margin is 50. For LIFO, it's the opposite. Okay, LIFO is we sell the newest rice first. So the rice that was most recently received would be the rice that's the first sold. And so the assumption then is we're going to sell the 10 tons that cost $9. And so our cost of goods sold is 90. For the average, we would just basically say, okay, we have 20 tons. Average price is 15 per ton, and our cost of goods sold would be the average per ton. So you can see three different cost of goods sold numbers, three very different gross margins then, or gross profits, sales minus cost of goods sold, based on which method we choose to go with. And so we always have to make that assumption that goods are going to flow through our business a certain direction. Now, that doesn't mean if we choose FIFO, that we have to literally sell the oldest rice first. It really doesn't matter which rice we sell to our customer. Rice is rice. It's just as we do the accounting, the assumption is that the goods that are oldest, we're assuming are sold first. Okay, so we just come up with a method, a methodology, and that's how it will apply to our accounting. Okay, so FIFO versus LIFO, some key differences between the two. LIFO gives a better reflection of cost of goods sold on the income statement. Therefore, LIFO is a better measurement of net income. FIFO, though, gives a better measurement for inventory in the balance sheet. So FIFO is a better measure for inventory value. So the problem is we can only choose one. We can't choose both. It's one or the other. And so we have to make that decision as a company, which one makes the most sense for us as a business. And the key thing is, once we choose a method, we stick with it. We can't change methods from year to year. We just can't do that. We have to pick a method and stick with it. Okay. And so when it comes to managing your inventory, it says here it's a balance. Okay. The balancing act is we don't want to have too much inventory on hand because it has a cost. We have to buy it, we have to pay for it, we have to insure it, we have to store it. But we also don't want to run out of inventory. If we run short, we're going to lose sales. Customers get upset. We can't fulfill an order. They come to our store and our shelves are empty. They're not going to come back. So there's a fine line there between having too much and not having enough. Okay, and both sides are bad. Too much means we're tying up resources. Not enough means we can't fulfill customer sales or expectations. Okay. And so we can analyze inventory a couple different ways. We can look at some ratios to help us understand how well are we managing inventory and inventory turnover. You can see here that we're looking at a ratio. A ratio here is called cost of goods sold divided by average inventory, which is a inventory turnover ratio. And you know, before I go too far though, I should mention, let me just go back a screen here, back to LIFO versus FIFO. I should mention that the book has some very good examples of cost flow assumptions with inventory on pages 283, 284, 285, 286, and then a final comparison on 287. So take the time to read through those examples in the book. Okay. I kind of gave you a high-level view of what each method is trying to accomplish. They've got some very good examples in the book. Make sure you read through those. Okay, I forgot to mention that earlier. Okay, coming back to ratios and then using ratios as a way to evaluate inventory. This is on page 290. And so the first ratio is the number of days sales in inventory. Actually, I skipped one. Inventory turnover is the first ratio to look at. And we're taking cost of goods sold and we're dividing it by average inventory. Average inventory is basically what was my inventory balance this year, what was it last year, adding those two numbers together and dividing by 2 to get an average. Okay, so it's just 2 points in time that are averaged. Okay, so cost of goods sold divided by average inventory. And that gives me a number, obviously, and that gives me a number in terms of how quickly, how many times in a year do we turn over our inventory. So basically that process of buying inventory, putting it on the shelves, and then selling it to our customers. How many times a year does that process happen? Obviously, a big box retailer like a Walmart, like a grocery store, that's going to happen very frequently. That number would be lower for your car dealership, you know, a big manufacturer who's manufacturing expensive items. It's not going to be as fast. Okay, so how quickly do we go through the process of buying inventory, putting on the shelves, and selling it to our customers? Next is number of days sales and inventory, where we're taking the days in a year, 365, and dividing that by our inventory turnover ratio. Okay, and so that was the number from the previous ratio. Okay, and they kind of tell us what that formula is here in the green. And we are then computing or trying to figure out our cost, or basically how long does it take us to sell our inventory? Okay, how many days does inventory sit on hand before it's sold to a customer? Okay, so the higher the days, the longer we're holding it before it's sold. And typically, we don't want to hold our inventory very long. Typically, the quicker we sell it, the quicker we're getting our cash from a customer by selling inventory. So the longer we hold it, the more costly it is as a business to hold that inventory, keep it stored, keep it insured. What if inventory gets old, if it's sitting around so long? What if it spoils? What if the technology built into inventory is, kind of has a finite future? We want to make sure that we sell that inventory and get rid of it. Next is measuring the operating cycle. And in this formula, we're taking the number of days in a year and we're dividing it by another ratio. We're taking purchases and we're dividing that by average accounts receivable. Okay, and we're trying to figure out how many days worth of inventory does the company have tied up in inventory, or I'm sorry, in accounts payable. So how much inventory is tied up in accounts payable? Okay, so how much do we owe for inventory? The next thing to take a look at is inventory errors. So inventory errors. What if we make a mistake when it comes to doing accounting for inventory? Okay, and what are the kind of mistakes that we can make? What if we did a bad count? And so we've got a bad beginning inventory number. We did some bad accounting, so we've got a bad purchase number. What if we have a bad ending inventory number? We did another bad count. All those errors will affect certain items on the income statement. Cost of goods sold. So if my cost of goods sold is wrong, that means my gross margin is wrong. That means that my net income is wrong. Okay, so we have to keep all those things in mind when it comes to accounting for inventory. Okay, and so this chart right here, and they give us some of the same information, not expressed this way, but with numbers in the book on pages 294 and 295, and where they're taking some incorrect numbers and they're walking us through how they affect other subsequent numbers and so on. They're walking us through that with some numbers on those pages. But this graph right here will give you some ideas of what happens when specific errors are made. So the first column is we've understated ending inventory. So we had a bad count and we counted too low. Okay, certain items are still fine. Sales, beginning inventory, purchases, goods available are all okay, but I made that mistake with my ending inventory number. I counted too low. That means my cost of goods sold is too high. If my cost of goods sold is too high, that means my gross margin is too low. This will not affect expenses. That means my net income is too low. Okay, and so you can see we can different kinds of mistakes that we can make affect different financial statement lines different ways. Ultimately, how does it affect the bottom line? Okay, net income. And you can see a couple of mistakes, it's too low, a couple, it's too high. Perpetual LIFO and average cost. It says here that some complications can arise because the last in and average cost change with every new purchase. Okay, every time we make a purchase, there's a different price per unit, which affects LIFO and average cost. Okay, and so we have to recompute cost of goods sold after every new purchase is made, which is a lot of work here, it says. And these complications do not occur if FIFO is used because the first in is always the same. So last in changes every time we make a purchase. So just something to think about for both LIFO and average cost. It does not apply to the FIFO method. Some other items to think about when it comes to inventory is the concept of net realizable value. Net realizable value. This is in your book on page 299, and this is the selling price of an item less any selling cost. Okay, and it's also used to value inventory when something is wrong with the inventory. What if inventory is damaged? What if it's been used, like a floor sample? What if it's become obsolete? And so we have to sell it for pennies on the dollar. You know, a clearance item at the store, you know, is basically obsolete. It's out of season, it's been replaced with a better model, and so it's hard to sell it now. Okay, so inventory that has some issue in terms of damaged, used, obsolete has to be written down. And so we have to write it down to its net realizable value, what we truly expect to receive by selling the item. And that journal entry you see at the bottom here is we debit a loss account, we debit loss on write down, and we credit the inventory account. So we're literally writing down inventory, decreasing asset, and increasing expenses or increasing the loss. Okay, so it's being very conservative with our approach to inventory. Which leads us to the concept of lower of cost or market. Okay, the lower of cost or market is in your book on the bottom of 299 and also on 300. And it's the basis for valuing inventory at the lower of two things. What's lower between original cost or its current market value? Sometimes current market value is defined as replacement cost. So in other words, let's put our hat on as we are accountants for Best Buy. Okay, so let's imagine it's the end of the calendar year or the end of the fiscal year for Best Buy, and we want to do an inventory account. And so let's say we're in the back of the store, in the storeroom, and we're counting inventory. And we come across a stack of TVs, okay, and it's gathering dust in the corner of the warehouse. And we get a little worried about that, and we do some investigating, and we realize we bought these TVs, let's say 9 months ago, and they just never made it to the sales floor. We never got a display model out, they never got sold. And so something like electronics, where over time with electronics, prices go down and quality goes up, and that's especially true for TVs. If you buy a TV today, it's much cheaper than it would have been 5 years ago with the HD TV. You're thinking like, especially a high-end HD TV. When that technology first came out, it's very expensive. The early adopters pay a lot. The late adopters pay less than the early adopters. And so if I'm the accountant at Best Buy, I'm realizing that there's a very good chance that I cannot sell these TVs for the price I paid to acquire them. So in other words, the replacement cost, what it would cost to buy them today, could very well be below their true market value, the true cost I spent to acquire them 9 months ago. And if that's the case, I have to mark them down. And so it says here, market value is determined by looking at three things. Okay, the ceiling is the maximum amount I can get to sell those TVs, which is net realizable value, which is sales price minus selling cost. Okay, now if it's an old model, the price is going to come down. Okay, number one. And then I have to keep in track or keep thinking of also what are any sales costs associated with selling an item. Okay, maybe a commission would be an example of that. Next is replacement cost. What I could buy that TV model for today or something very near it. And I could find that out simply by calling up my supplier. If it was a Samsung TV, I can just call up Samsung and say, okay, I've got this model of TV that I bought 9 months ago and I paid X dollars for each unit. If I bought the same ones today, what would you charge me? Okay, and now I'd find out. That's my replacement cost. And the floor then is replacement cost minus a normal profit. What would the markup be expected to be on that TV, on that model? Okay, and the market value is the middle of the three, which is replacement cost. So whatever that middle value is, that's what my true market value is. So in that example I just gave you, there's a very good chance that those TVs are going to have to get written down, okay, because their true market value has now gone down. And so when it comes to LCM, lower of cost or market, I compare different values. So I'm taking each of these four items A, B, C, and D. I'm just looking at this from left to right, and I'm looking at the cost, the floor, and the replacement cost, and then the net realizable value ceiling. And I'm choosing the number that's in the middle. Okay, and in this example I'm using 30. For item B, I'm using the market replacement cost of 36. And I'm basically looking at what's in between cost and floor. Okay, with item C, kind of the same thing. I'm going to use the floor of 44 is in between cost and market replacement cost, and so on. Okay, so replacement cost, I choose that if replacement cost falls between ceiling and the floor. Okay, then I use replacement cost, which is what item B is. The floor is if the replacement cost is less than the floor. Okay, so I use the floor for item C because for item C the replacement cost is less than the floor. The ceiling is used, and we used ceiling for item A if the replacement cost is higher than ceiling. Okay, so that's when I used the ceiling. When replacement cost, ceiling, and floor are compared, mark it as always the middle value. Okay, compare the defined market value with the original cost, and choose the lower amount. Okay, the defined market value with the original cost, and choose the lower amount. That's just simply being conservative with our value of inventory. So what we report on the balance sheet should truly represent what we expect to realize by selling that inventory. Okay, LCM can be applied a few different ways by computing cost and market values for each item of inventory and comparing the two figures in each case. Like for items A, B, C, and D, we could look at each individually. Or item number 2 by computing cost and market for the total inventory and applying the LCM to the total, or by applying LCM to categories. So that A, B, C, and D could have been 4 different kinds of inventory, or it could have been 4 categories of inventory. Okay, that's each way would have been a way to think about the example that we just got done looking at. They give us some really good examples of this also on page 300 of your book. Okay, another final thing, a final topic, is the gross margin method of inventory. The gross margin method of inventory is used to estimate ending inventories, and this method is described on page 302. It's used when a physical count is either impossible or impractical. There was a flood, there was a fire, some natural disaster destroyed inventory to the point where we can't count it anymore. Okay. If we know certain things, we can do an estimate. So it says cost of goods sold and ending inventory are estimated based on using available information that we know is true. If we know our beginning number, and if we know our purchases, that will go a long way to estimating ending inventory. Another key thing is to know historically what is our gross margin percent. In other words, by what percent do we typically mark up our goods? And if I know those 3 things, I can do a calculation that looks just like this. Okay, because I always know my sales, and if I know my beginning inventory, right here, my 15,000 beginning, I know that number is hard and true. I know my purchases, I've been documenting purchases, so I know that I've got available to sell to my customers $80,000 worth of inventory. Okay, so the next step is I want to estimate my ending inventory. And if I know what my cost of goods sold and my gross margin percents are, I can do that easily. So in this example, we're saying for every dollar of sales, 40 cents or 40% is gross margin. So if I have for a dollar of sales, 60 cents is cost of goods sold, 40 cents is gross margin. Okay, that's basically what we're saying here. So if I've got 100,000 worth of sales, that means 60 cents or 60% or $60,000 becomes cost of goods sold. The difference becomes gross margin. And so if I've got available to sell 80,000 worth of goods, I estimate my cost of goods sold to be 60,000. That means my ending inventory number has to be 20. Okay, so that's what we're saying here. That's how we're computing that. So I know some things, but I have to estimate basically my gross margin. And if I can estimate my gross margin, then I can estimate cost of goods sold and ending inventory. Okay, we'll wrap it up with that. That will end our chapter 7. We'll have a WebEx talking about it also. So be sure to read the chapter. Be sure to there's always these purple remember this items throughout the chapter. Those are always really good to review also. And always remember that at the end of every chapter, there's a good study guide there available for you, including terminology that we covered throughout the class or throughout the chapter.